The past 4 days have been challenging for crypto investors, to say the least, as Bitcoin failed a bullish reversal attempt on January 20th and plunged 22% from a high of 43,500 down to a low around 34,000 over a 2-day period before stabilizing around 35,000 over the weekend. Altcoins were hit equally hard, with most of them falling even more than Bitcoin. Will the bleeding soon dry up and lead to a recovery in crypto, or is Bitcoin now positioned for even lower prices? In this video, we look at the big picture with a top-down chart view of Bitcoin to show how the price of Bitcoin has reacted to previous sell-offs over the years. In doing so, we aim to shed some light on the current situation and help you to understand the big picture of where we are in the crypto cycle. If you're relatively new to trading crypto, it's crucial that you first understand the historical cycles that Bitcoin has repeated with high reliability since its creation in 2010. Bitcoin tends to operate in periods of 4 years that are known as a supercycle. Historically, each supercycle has lasted about 4 years, with each cycle ending in a sharp sell-off that eventually leads to new all-time highs when the next cycle begins. Let's take a look at what we're referring to help get some insight as to the big picture and the long-term view. What you're looking at here is a monthly chart going back to just towards the end of 2011. It's a monthly chart, so each bar you see here is 1 month of price action. So we're going back about 10 years. So the first 4-year cycle started to end around November of 2013. And if we look at measure the pullback that we had from the top of that peak, we peaked out just around a little bit over $1,000. Bitcoin was trading at as of November 2013, and we found a bottom and formed a low at about 150. So from 1,100 down to 150, you can see was a decline of about 86%. And that 86% decline stretched from November 2013 all the way to the lows that were formed in January of 2015. So basically lasted a whole year, actually about 13 months was the pullback, 86% off the highs. Now, if we fast forward 4 more years, the next time this same cycle occurred was in late 2017. And coincidentally, or not, we actually formed a peak again right around the same time in December of 2017. And let's go ahead and measure the decline. Again, from December all the way down to the lows, we see that we had a decline of about 84%. And again, this went from December 2017 until the lows that were formed right around January 2019. Notice the similarities, 13 months and almost the exact same correction, 86% and 84%. Now, an 86% correction back in 2013, if it was the stock market, you would think it's over and that's the end of the stock market. But this is crypto, and crypto is volatile in both directions. So in both cases, this correction of roughly 85% in 2013 to 14, in 2017 to 2018, in both cases, it eventually led to new all-time highs within a period of several years later. And let's go ahead now and see where we're at, because the last time this cycle started was November of 2017. And if we fast forward 4 years, that means November 2021. And guess what? It looks like we're starting the same thing again, because we see we had a peak here, a new all-time high was formed in November 2021. And currently, if we look, we see currently we're down about 49% from those highs. One thing that's important to note is each time we form a new highs within the cycle, the pullback has not violated the highs of the previous cycle. So for example, when we pulled back 86% back in 2013, notice how the lows of that pullback actually held at the previous all-time highs of the previous cycle. We did not go below that. And then again, in 2017, despite an 84% pullback, we held well above the highs, the all-time highs of the previous cycle, which was back here around the 1,000 mark. We held above that. So now we've started another cycle, and we've already pulled back 49%. And if that pattern holds true, that would mean we would not violate the highs of the previous cycle, which is right around 20,000. But if we're only down 49% only, does that mean that we're going to have to drop all the way down to 85% again before we start to head back up? Well, not necessarily. Now let's go ahead and zoom in from a long-term view to an intermediate-term view to see what's been happening over the past year or so. So now we're looking at a weekly chart. So each bar is 1 week of price action. And you can see 2021 started here. So this is basically the past year that you're looking at here on the screen. Now, as we mentioned earlier, the current pullback that we have in the market goes from a high of 69,000 that was set actually back in November for the third time in a row out of these 4-year cycles. November was the high. And currently, we are on a pullback, and the pullback at the lows was about 50% deep, currently about 49% off the highs. Now, what's notable is that we actually also had a similar pullback back in April of 2021 when we formed an all-time high of 65,000, and we pulled back all the way down to about that's about 29,600, which was a 54% pullback from the highs. Now, what's interesting about this pullback from April to July of basically last summer, is that within a few months later, we were all the way back up at new all-time highs, despite a 54% pullback. Now, what surprised a lot of people, and it was surprising to us as well, is that we actually expected to see lower prices when we came down in July, because we were consolidating at the lows for several months, and it looked like we were going to bounce and roll over to form low prices, but apparently the whales and institutions started stepping in and rallied the price right back up off those lows, and there was some definite institutional buying support there. But just as we had institutions and whales moving the price back up, now we see the price right back down. Here we had these big green bars. Now we've got some big red bars, and we're pretty much right back where we started, where we were in July of last year. Now, if we look at the lows from last summer, the lows are actually, as I mentioned, right around the 29,000 mark, which I drew a horizontal line, you can see, and we're currently hanging out right around the 35,000 mark. So from 35 down to this, the low of last summer support is about a 6,000 point drop, or about price is currently about 20% higher than the lows of July 2021. So we may get a decent bounce in the short term, which we're going to look at shortly. But as for the intermediate term, we're really looking at this 29,000 to 30,000 area as a major level of horizontal price support. We can see here kind of the channel between the lows of these wicks and the bodies, right around, actually it's about the 20, just below 29 up to about the 32,000 area. So look for this area to be a major level of intermediate term support in the coming weeks. And that's what we're looking for, is expecting to come down a little bit more after we maybe bounce a little bit in the short term, but we do expect these lows to be very significant. We believe that this time around in this cycle, this 29 to 30,000 range is where institutions actually started stepping in, and big players started coming into the market. And we don't believe we had that in the last cycle 4 years ago, because we're just now starting to gain institutional level adoption, such as Michael Saylor buying into Bitcoin for MicroStrategy, his company. He's got an average price right around 29,000. And we believe that there was a lot of institutional support that stepped in here to run the price back up when we pulled back. So as a result, if we're getting a pullback back down to this level, we do believe that institutions are going to want to protect their investment and try to support the price. So we may not rally right back up, but what we think is a likely scenario is a period of sideways consolidation. Remember that prices can correct one of two ways. We can either have a correction by price, which is a retracement, or we can have a correction by time, which is sideways consolidation. So a very likely scenario is that we could pull back to the 29 to 32,000 range and just trade sideways for the next year. Okay. And if we do that, that wouldn't be such a bad thing, because we'd find some tradable moves in the short term and some altcoins with relative strength as well. And we believe that this time around, rather than dropping all the way down 85%, that we're going to more likely see sideways consolidation. But of course, we trade what we see in the market, not what we think. So anything is possible. We must be prepared for that. But if we had an 85% correction from the highs, that would actually take us below the 20,000 mark. It would take us all the way down to about 10,000, which would take us below those prior highs we showed you of the prior cycle. So we go back to the monthly chart, we can see from the prior cycle here, the highs right around 20,000. So if we went all the way down to 85% correction, we'd go below that, and that hasn't happened yet. It's possible, but it hasn't happened in any of these cycles. So for now, the most likely scenario is looking to find major support around 29 to 32,000 in the intermediate term. Now let's zoom into the shorter term. Now looking at the shorter term, where we might see the price action take us over the next couple of weeks, let's take a look first of all at the channel that we have that's developed from the prior highs at 65,000 up to the most recent all-time highs at 69,000. We can see the trend line there, and if we draw that channel down, we extend that channel. What's very interesting, notice how the upper channel resistance from the all-time highs from 65 to 69,000, the angle of that channel also correlates to support on the lower end, and we're approaching that support level. So we may see a significant bounce as we come into support of this channel that we've had here in place over the past couple months. And if we do, then most likely we get some type of a Fibonacci retracement. And drilling down to the daily chart time frame, we can see that right around the 39,500 level is going to be resistance, because that was our prior level of support that we recently spoke about in a blog post, where we said that Bitcoin had support around 39,500, but that support has been broken. Notice how we broke below the prior lows here, and that happened just last week when we broke below that 39,500 level. So technical analysis says that a prior level of support becomes the new resistance after the support is broken. So therefore, we now expect any bounce to run into resistance right around just below the 40,000 level. But if we get past that, then we could definitely see a bounce up to about the 44,000, the prior highs there. So we're looking for a bounce in the short term from the 39,000 up to about the 45,000 range in Bitcoin, which may provide a nice tradable bounce in the altcoin market as well, because a lot of the altcoins are beaten up much more than Bitcoin. Some of them are down 70, 80% off their highs. And it feels like the whales are setting up for a nice altcoin rally once we've got some momentum and a base established, at least in the short term, on Bitcoin. So we'll be definitely keeping our eyes out for that. For now, our portfolio, the Morpheus crypto portfolio, is all cash, but we will be keeping an eye out for some short-term tradable opportunities as we come into support. Now, as we've discussed recently in the chat room, crypto has been tied to the performance of the NASDAQ lately, and the stock market has been selling off due in part to the federal government stating that they will have a hawkish stance on raising rates to combat inflation throughout this year. Now, this Wednesday, on the 26th of January, we've got a meeting of the Fed, and they will announce their stance, their latest stance, and their monetary policy. And the reaction to that is going to largely determine the short-term trend of crypto. Now, keep in mind, the Feds have to walk a balancing act here, because obviously they want to combat inflation, so raising rates is the way to do so. But that also has caused a negative effect on the stock market, so that they're not going to want to see trillions and trillions of dollars of wealth wiped out from the stock market with a much bigger correction, because of course that would have its own implications for the economy as well. So they do want to see it fall a little bit and come back into normal correction levels. And the market was pretty overheated. So it'll be very interesting to see what the Fed does, if they are going to, in fact, back off on their hawkish stance of raising rates, or if they will proceed and let things play out as they will. So that's largely what's going to determine, I think, the next move in crypto in the short term. But the short term is just noise. And as we showed you, the 4-year super cycle is really what matters. And it looks like if things are going to be slightly different this time, that we may be keeping an eye out for not much lower levels and perhaps a sideways consolidation as we enter the next phase of the super cycle. Again, we believe there's much more institutional adoption and institutional players than we had in previous cycles that may actually cause the cycles to lengthen and may actually limit the amount of the downside, so that we don't have a full 85% correction, which would violate the prior highs of the all-time highs of the prior cycle. So we believe that maybe worst case scenario would be coming down to that 20,000 level, which would be about a 70% correction. But that would be major support, because that was the prior highs of the prior cycle. But for now, we're looking at around the 29 to 32,000 level. So we hope this has been helpful to give you some insight on the big picture of Bitcoin and where we may be headed. It can be definitely scary when things are falling as quickly as they are, but this is crypto, and what goes down goes up just as fast in crypto. And we just need to basically be ready to take advantage of the market's next opportunity, and most importantly, be able to trade what we see and not what we think, because anything is possible in trading.